What's Draghi going to deliver?
Well, I think that we know the markets are already pricing in a 10 cut in the repo rate, so deeper negative rate in the front. But more importantly, last time, and the market doesn't expect, was basically an increase in the monthly rate of purchase from 60 billion to 75, which was the expectation which he led the market down. And I think that, we should put that back on the table. And the reason really is that even if you looked at the ECB's projections 2 years ahead, the inflation is still below 2%, very below the target. You got very high unemployment, so there's no wage pressures really building in the system, and you got housing market which is pretty flat. So I think that he needs to do something to get the economic growth rate going. We got a lot of one-offs which have kept the inflation rate down, fall in energy price, fall in commodity price, and I think we can look forward to the next year or two when there's going to be export or deflation from China and most of Asia, which means that the inflation worldwide will remain under severe pressure, to stay low. That means that the time horizon before inflation get to 2% is going to get longer and longer. It's going to lengthen unless he comes and increases the amount of the QE he is doing. Of course, on the table is the fact that the expansion of the asset that he's going to be buying in terms of what is available on the marketplace. And there's a lot of speculation whether the investment-grade corporate bonds are going to be something that he will open to buying. And so we need to, that would be a very positive move. And the chances are that that's increasing in probability, as days goes by.
The ECB, you could argue, is its own worst enemy. On one side, it's trying to do everything it can to deal with inflation. On the other side, it's making it harder, some would argue, for banks to lend. If you look at the weightings that the banks have to do, the whole issue of the banking sector is problematic. So what one hand does, the other hand negates. Is that how I should look at the ECB?
Well, unfortunately, the problem with Europe is that 80% of the credit that is transmitted in Europe comes from the banking sector, and only 20% from the market side, and which is inverse in the US, where 80% of the credit comes from the market side, only 20% comes from the banking sector. So in terms of, the banks are having to obviously strengthen their balance sheets because Basel III is gradually getting implemented all the way to 2019. So they have no choice but to strengthen their risk capital base, and that means that they can't expand their lending book very easily because then even more risk capital is needed. However, it's a gradual step function process, and the cost of capital has come down quite significantly in Europe. New mortgages in Spain now 2.25%. So the lower interest rates via the QE is going to the household, is going to the SMEs. And ultimately, this is what stabilizes the housing market, stabilizes the consumer balance sheet, and then effectively it reduces the stress in the bank balance sheets, and we get nearer to the time when the banks can begin to lend far more aggressively because the customers are much better able to afford lower interest rates. So I think, another few quarters and we'll be in a position where the bank lending begins to lift off quite significantly. We've already seen that the lending standards have eased a little bit, the availability has improved a little bit.
So why should Draghi do anything? Monetary policy acts with a lag. If you're saying in a few quarters' time we're going to start to see credit improving.
But I think the point really is that, yes, the inflation target is not going to be met for some years to come. And if they are serious about trying to get the system inflation to 2%, they need to increase the help that they're giving to the economy to get the economic growth rate to pick up a little bit. Yes, it's coming, but I think it's still a slow lift-off, and it's going to be another year or 2 years before we see the growth become sustaining in the sense that the lower cost of capital feeds through into the system, into higher demand and higher economic activity, and then higher employment creation and better wages as a result of all of that. But this is a very long, slow leg reaction.
Long slog basically coming up. Ashok, thank you very much indeed. Ashok Shah, Investment Director at London and Capital.